Okay. Now what we'll do is we'll just have a look at module 5, which mainly concentrates on what are referred to as the credit risk. What do you mean by credit risk, and what were the various credit risk instruments which were part of it? And in this module, you'll be able to understand how the crisis of 2008 financial crisis also happened. So before we go into step by step into all these topics, let's first understand in terms of what exactly is credit risk. So if you look at the credit risk or the entire gambit of credit risk, you will be able to understand that to a certain extent. We do observe that the bond prices and the probability of default, you have got various instruments which are there, which are referred to as credit default swaps, total return swaps, everything else. These are the aspects that we will be discussing today. So when it comes to credit risk, you will be able to notice that if you have lent, if you personally have lent to any person, or if the companies have lent to any other company, there will be always exposure to counterparties in terms of the contractual obligations which are there. There might be chances that the counterparties which are there might not be able to pay. And due to this reason, there will be the creation of what is referred to as the credit risk. And thus, what companies often try to do is they will try to choose the counterparties very, very carefully based upon the factors such as reputation or credit worthiness and a few other factors also. So if this is the case, if the company wants to enter into any contractual obligations also, the main players who are mainly involved might be supplier, customers, investment and lending firms. And if there is any counterparty risk which is created through this is always referred to as operational credit risk. And if you have instrument based credit risk, then you will be able to find out that these are often seen in organized or in terms of the OTC market or over the trade markets. And thus, when you look at credit risk management, and now you know that it is the companies have obligations to have transactions with various players, and during these transactions there will always be credit risk. And thus, if companies want to go for credit risk management, then what they should be able to do is they should be able to look at two aspects. And these two aspects is, one is they should be able to identify whether there is risk exposure or not, to what extent the risk exposure exists. So this is first aspect. And if they identify there is a risk exposure, then what kind of tools they can use in order to eliminate it or minimize it is the second aspect that they will be looking at in the credit risk management. And thus, the measurement of default probabilities is one of the crucial steps which are there for determining the credit exposure. And thus, this is one of the video on global financial crisis, and you might recognize Michael Burry also, wherein he was the one who was able to predict that the financial crisis will happen in 2008, and he made a lot of profits also during this time. So just have a look at it. This is a long video. I just want you to go through this video. When you go through the slides and the PPTs, everything else, but just have a look at just summary.
Home ownership has long been the classic American dream, and throughout the decades, banks have continued to make new home loan products to help as many Americans as possible achieve that dream. Not to mention that governments as well have also been very supportive of these measures, as at the end of the day, it helps more Americans get what they want. However, one man by the name of Michael Burry saw big problems evolving within this system in the early 2000s, and ultimately these big problems would be left completely unchecked, so much so that it would eventually decimate the housing market and the American economy. So how did Michael Burry see this coming? How did he bet against the American housing market? How did he bet against the American dream and come out on top? Well,
So this video is closer to almost like 19 minutes. So what I want to just have a look at is, just a minute. So let me explain this video which is there as to how the global financial crisis of 2008 actually happened. So if I could explain, if someone wants to have a house, okay, specifically in Bangalore, for example, the one aspect that they can do is either they can get the house on lease and stay for rent, or otherwise, if they have large amount of money, they can build the house, or if the house is already built, then they would be able to go and purchase it. Many of the times what happens is many of them would like to have the house, but they would like to pay for the various payments which has been to be done through various EMI. So in US, what happens is there were houses, there were big houses like villas, everything else, and then the real estate agents, what they did was, or the in terms of the real estate industry, what they did was, in order to sell more houses, they went to the borrowers. These borrowers are referred to as subprime borrowers because consider that a person is earning, for example, 10,000 rupees. And if he is earning 10,000 rupees after he has paid all the expenses, everything else, he is left out with 4,000. And with 4,000, he should be able to pay the rent and make savings also. So he would have maximum like 1,000 rupees in order to pay for the EMI. But who will be able to give you a bigger house, a villa, with the EMI of just 1,000? So similarly, what happened in USA is the real estate industry. What they did was, since the housing prices were going down, they said that why don't we take a chance wherein we will go and ask the subprime borrowers who can pay very less EMI. Okay, the EMI, consider that it is something like just 10,000 rupees or 5,000 rupees, and they can go and have a house which is like two-story building, or it is like a penthouse, and thus they were able to give lesser EMI, and thus the real estate industry said that you can definitely afford it, you can own a villa, and then for that you have to be able to pay a very lesser EMI. So what would all the people who are having just 10,000 rupees, they have to just pay 10,000 rupees and they will be able to own an entire house. So if that is the case, you will be able to notice that the prices of the houses started booming is for the reason that the houses were given to subprime borrowers who were in turn paying lesser EMIs, but they were all owning the houses. Since they were all owning the houses, there was a real estate boom. Now, what the real estate people did was, since the house has already been given to a subprime borrower, you will be able to notice that they will be able to get EMI. Within this EMI, there is one principal component, there is an interest rate component. So what real estate industry wanted is, they wanted this risk to be transferred, wherein within this EMI, if they can get the principal amount, for example, this house is worth 10 lakh rupees, for, with the interest, you will be able to say that it is another 3 lakh rupees. So 10 lakh rupees plus 3 lakh rupees. Now, the real estate industry, what they did was, they said, is there any person who will be able to take the risk wherein they can give me the principal amount of this house, which is nothing but 10 lakh, 3 lakh rupees, which has to be obtained through the interest rate, can be given to the person who will be able to pay me the principal amount. From whom? From the subprime borrower. So there were a lot of investment banks, Freddie Mae, Fannie Mac, there were a lot of investment banks which were there. So you will be able to notice that these investment banks came to real estate industry or real estate companies, and they said, we will give you the principal amount of all these houses which are there. The interest amount which is there, we will be able to collect it from the subprime borrowers, and thus we are ready to ensure that there is a risk transfer. And thus you will be able to notice that the entire amount which is there was transferred, the risk which exists with the real estate companies was transferred to the investment banks. And then if you notice, if investment banks have taken this risk, they should be able to profit from it, right? So what these investment bankers did was, they in turn converted these um, uh, the worthwhile EMIs that they were supposed to get. They said these can be converted into instrument, or it can be converted into securities, which is referred to as the securitization. So what they did was, they converted these instruments which were there, or this loan amount that was transferred, they converted that into securities and sold that in the stock markets in the form of stocks. And since there was lot of real estate boom, since there was the subprime borrowers were paying the EMI, everything was going fine, the rating agencies said that the stocks are worth triple A grade, and thus these stocks were bought by governments, mutual funds, FIS throughout the world. And you will now be able to understand that whenever one talks about in terms of the stock markets, you should always be able to understand the underlying instrument. You should be able to understand in terms of the fundamentals. So what people did not understand is, the value of the stock which is there is in turn dependent upon whom? Is in turn dependent upon these subprime borrowers, who should be able to pay the EMI. So since more and more subprime borrowers are paying the EMI, the stocks of these instruments which have been sold by the investment banks is going up. But there came a time when many of the subprime borrowers, they felt that the EMI that they are actually paying is very, very high. They cannot actually afford it. So majority of the people, what they did was, they said, I don't want to pay EMI. If I've got this house, I would like to um, just leave this house and go and stay in another smaller house, but I don't want to pay this EMI. So what started as one or two borrowers not paying the EMI, this was followed by majority of the homeowners. They were not able to pay the EMI. If these people are not able to pay the EMI, what will happen to the housing prices? The housing prices will automatically start coming down. If the housing prices start coming down, you will be able to notice real estate industry, they already have got the amount from the investment banks. Principal amount they have got it. The investment banks are supposed to get principal amount plus interest from the subprime borrowers. Now, if these people do not pay the EMI, investment banks will not get their principal amount plus interest. If they don't get it, these stocks which are there, these are valued based upon the EMIs. The stocks will automatically start coming down, which none of them actually realized. And this led to what is called as the financial crisis. And remember, the stocks were sold for like 1000 rupees. Okay, consider that it was sold for 1000 rupees. The value of these stocks came to almost closer to 1 rupee or 0 rupees. So if it comes to 1 rupee, the government's mutual fund houses who had invested into these stocks, considering that they are very, very, they are not risk, they do not have any risk at all, the 1000 rupees worth of stocks automatically became 1 rupees or 0.5 rupees. So if this is the case, majority of the governments which are there, you would have heard that Greece, you would have heard about in terms of uh, the investment banks which were there, for example Freddie Mae, Fannie Mac, which were there, these companies which had existed for 100 or more years, they went bankrupt suddenly. And thus, you will be able to notice that when it comes to credit risk in the banking sectors, so now you will be able to notice that after 2008 financial crisis, majority of the companies which started lending, they became very, very careful. They wanted to avoid in terms of various risks which were involved with respect to counterparty risk or credit risks. And they wanted first to understand the instruments where they are investing. And thus, there were a lot of changes which were brought in from 2008 onwards. And you will be able to notice the key instruments which were mainly looked at from a point of view of the banking sector is first one is in terms of the letter of credit. In the letter of credit, you will be uh, able to notice that when we talk about in terms of letter of credit, we always say that there should be an assurance from the bank. So if I am an exporter, I should be able to get an assurance from the bank which is there in the country where the importing company is there. So if that is the case, if I'm able to get the assurance from the bank that the uh, company which is importing the product will be able to pay for it, then uh, that will be, yeah, that is an assurance that I can export my goods. So that is nothing but in terms of the letter of credit. Second one is you have got in terms of the credit guarantees also, which came very often now. And then people started saying that the principle of investments that we follow should also be followed for credit risk instrument also. So one started going for portfolio diversification strategies also. And the credit insurance is the one aspect which is uh, though it has become very, very famous throughout the world, but in India it is still picking up. And then you have got the negotiating collaterals market to market, which we'll be discussing in the next slides. So when it comes to in terms of the credit risk reporting, how does the reporting actually happens is you will be able to notice that any exposure to the credit risk is always shown in the books as in terms of the receivables. And we know that dependent within this receivables also we will have short, medium, and in terms of long term, wherein we will be able to designate any receivables. And if a receivable is not obtained beyond 80 days, 180 days, or 360 days, we will certainly be able to say that whether there exists any risk component, what is the amount of uh, bad debt that can happen. And then you will be able to notice that the companies also go for credit insurance. But these two things are found to be inefficient due to the reason that they are always attached to the assets of the firm. And thus what we need is we need the help of in terms of the credit derivative products, which we'll be discussing more in depth. So thus you will be able to notice that actual defaults which are there can happen anytime and due to various reasons also. But here the assumption which we have made is we are assuming that we are not only dealing with the companies within the country, but we are dealing with the companies which are in other countries also. Due to that reason, any changes in the interest rates, exchange rates, or in terms of the losses or failing economies will definitely have an impact on the defaults, and thus there will be existence of credit risk. And thus, as we noticed in terms of the 2008 financial crisis also, since we know that the loans are not transferable and lack liquidity, what people always do is they will convert these loans into security instruments and sell that in the stock markets, which is always referred to as in terms of securitization. And thus they came the concept of what is referred to as in terms of the credit derivatives or credit derivatives. And these were in terms of the instruments wherein what was the underlying instrument which was there was nothing but the loans. If someone is able to pay the principal and interest, if there was higher probability of receiving principal and interest, you will be able to notice the securities will be traded at higher prices. If you find that they are not able to, then the security prices will automatically come down. So the reward for owning in terms of any credit instruments, take for example a bond, will be decided based upon its capability to either pay in terms of the principal amount and in terms of the interest rate minus the risk-free rate of return. And thus we will be able to notice that if there are any chances that the company which is there is not able to pay the principal as well as in terms of interest amount, there is a deterioration with respect to cash flow of the firm. These events which are there, which leads to downgrading of the debt instruments, is always referred to as a credit event. And thus what people started talking about is we should be able to go for portfolio diversification. So the same concept of investment was also brought into derivatives also, wherein they said instead of you going for lending in terms of a lending and lending it to just one party, why don't we go for diversification? And thus you will be able to notice that the credit derivatives which were there, which was initially when they were considered as very risky in nature, what they now try to do is they went for diversification of the portfolios also, which were now referred to as in terms of the bundles. So if this is the case, what they did was similar to the financial crisis, is the loan instruments or the loan instruments will be further categorized into various subcategories, which are referred to as in terms of the tranches. And then what do you mean by in terms of the tranches is if you say that there is a high probability of you receiving the entire amount of loan, principal plus interest, that is one category. There is 60 percentage probability that you might be able to get principal plus interest. This is second tranche, then third tranche, then fourth tranche, like that. They were able to create different classes of credit risk, and these were referred to as in terms of the basket credit derivatives which are there. And thus you will be able to understand that if I have to differentiate between the credit derivatives as well as in terms of the stocks, credit derivatives are nothing but they are not standardized, they are OTC traded. And you will be able to notice that they can be converted. There is a possibility of securitization, and thus they can be able to replicate the returns of the financial instruments also. And due to this reason, there is no necessity for you to hold the asset as you do in the stocks as well as in terms of bonds. And thus you will be able to notice that if we talk about in terms of doing problems and we want to know is there any possibility of credit risk or not, what we do is we take into consideration two bonds. And we take the bonds which have got differentiating interest rates which are there. So if we take in terms of the yields which are there on 1 year bond, 1 year risk-free bond, and in terms of the corporate bond, you will be able to notice that there exists a difference of 0.5 percentage which is there. So if and when we talk about bond, we are always talking about in terms of the present worth of these bonds. So if I'm able to replicate the same thing, present value is nothing but future value divided by e power rt. And if I take this e power rt in the numerator, it becomes e power minus rt. So if I use the same formula here, and if the face value of the bond is 100, you will be able to notice this is the bond on a risk-free bond, and this is on a corporate bond. Just make this correction. This is value of corporate bond. So if we are able to notice that there is a difference of 0.4608, and this is nothing but the value of loss which can happen on account of default on 1 year in terms of the present value terms. If I do this problem for 2 years, the entire formula remains same, except for the time period will be changed. And you will now be able to notice that the value loss from the default over 2 years will now be estimated as the difference between the risk-free bond yield with respect to that of the corporate bond yield. And that value is 1.3204 in terms of present terms. And thus This is one aspect that we'll be discussing, and in the next part, we'll be discussing mainly on the concepts of what are referred to as credit default swaps.